Imagine trying to sell an intangible promise, like a literal piece of paper that might pay out if a disaster strikes.
Right.
And you're trying to sell this to someone who has never fully trusted a formal financial institution.
Which is a huge hurdle.
Exactly. Now imagine building a multi-billion-dollar empire, doing exactly that, hundreds of thousands of times a day, without ever actually creating the product you are selling.
It is honestly one of the most fascinating paradoxes in modern commerce. I mean, you have a company positioned at the absolute center of a financial revolution, processing immense amounts of money, yet...
They don't own the inventory.
Exactly. They don't take on the risk. They just build the roads and, collect the toll.
Okay, let's unpack this. Welcome to this deep dive. Today, we are immersing ourselves in the mechanics of a company called Turtlemint Fintech Solutions, Ltd.
Yeah. And we are basing our entire conversation today on a highly detailed, comprehensive report. It's titled Turtlemint Fintech, Scaling India's Digital Insurance Distribution Network.
Right. And our mission here is to figure out exactly how Turtlemint is using what they call and I love this term, a phygital network.
Phygital. Physical and digital.
Yeah, physical human beings powered by digital tools. We want to see how they're using this to conquer the Indian insurance market, which, by the way, is one of the most drastically underpenetrated insurance markets on the planet.
Oh, absolutely.
So we want to understand if their high growth but currently loss-making model is actually a stroke of genius that leads to long-term dominance, or, if they're standing on incredibly shaky ground.
And to get to the bottom of that, we're going to look way beyond the top-line revenue numbers. I mean, we really need to dissect the underlying mechanics of this tech platform.
Right, the nuts and bolts.
Exactly. We have to understand the unit economics of a single insurance policy, like where every single rupee actually goes, and figure out how they are deploying their capital to sustain this, quite frankly, staggering growth.
Well, let's start with the engine itself. What does Turtlemint actually do? Because, when you hear the word fintech, your mind immediately goes to like a sleek app on your smartphone where you just tap a button, transfer money, and buy a policy.
Yeah, the typical direct-to-consumer play.
Right. But the source material is very clear about this. Turtlemint is a technology-enabled insurance distribution platform, but they absolutely do not manufacture or sell insurance directly to the end consumer.
No, they don't. If you are a regular consumer sitting at home, you aren't logging onto the Turtlemint website to buy a policy for your two-wheeler.
Right.
What they have built is a digital ecosystem. And the nerve center of this is the Turtlemint Pro app.
Okay.
This software connects three distinct groups that historically had a really hard time talking to each other. You've got the customers, the certified advisors, which Turtlemint calls digital partners, and about 45 different giant insurance companies.
It's the sheer scale of this operation that really stops you in your tracks. I mean, the report lays out the numbers, and they are enormous.
Oh, they are.
Like, as of December 2025, Turtlemint has 6.3 lakh digital partners. And just to visualize that for you, a lakh is 100,000.
Right.
So we are talking about 630,000 independent advisors running around using this platform.
Yeah, and out of those, about 5.07 lakh are fully certified point-of-salespersons, or POSPs as the industry calls them.
That is a staggering human workforce.
It really is. And those 6.3 lakh partners are moving a vast amount of volume. The sources note that between April 2022 and December 2025, this network facilitated 2.19 crore policies.
Wow.
Yeah, and a crore being 10 million. So nearly 22 million individual insurance policies.
That's wild.
And this generated over 10,066 crore in cumulative platform premiums.
Over 10,000 crore rupees in premiums, just, flowing through their digital pipes.
Exactly.
It immediately brings an analogy to mind, actually. Turtlemint is basically acting like Shopify or Airbnb, but for the insurance sector.
Oh, that's a good way to look at it.
Right. Because Shopify doesn't own the t-shirts you buy, and Airbnb doesn't own the houses you sleep in. Turtlemint doesn't own the risk of the insurance policies. Instead, they provide, the ultimate digital toolkit for independent entrepreneurs.
Yes.
These 6.3 lakh local advisors, so they can basically build their own storefronts in their own neighborhoods.
That toolkit is the crucial piece of the puzzle. But we have to ask why this specific model is so necessary. You look at that setup and wonder, why not just be a purely direct-to-consumer app?
Yeah, why do you need 630,000 human beings standing between the tech platform and the customer?
Exactly. Isn't the whole promise of the digital age to cut out the middleman entirely?
Right. If I want to buy something today, I just download the app and click purchase. Why add the friction of a human agent?
Well, in highly urbanized centers, or, in Western markets where people have been interacting with digital finance for 2 decades, you can absolutely cut out the human.
Sure.
But the report highlights where Turtlemint is actually operating. They have a laser focus on what is called the B30 plus markets.
B30 plus.
Yeah. This refers to towns and cities outside of India's top 30 metropolitan areas. We're talking about semi-urban and rural Farad. And in these regions, a purely digital distribution model simply fails.
Is that like a hardware issue, just a lack of high-end smartphones or good 5G coverage?
I mean, hardware and digital literacy definitely play a role, certainly, but the overwhelming barrier is trust.
Trust. Okay.
Think about the psychology of the transaction here. Insurance is an invisible product. You are asking someone to hand over their hard-earned rupees for a digital PDF that essentially says, if you get into a terrible accident or if your shop burns down, we promise to help you.
Right. And if you live in a community with historically low trust in formal financial institutions, a sleek website really means nothing to you.
Exactly. You need a face. You need a person from your own community, someone whose family you know, to sit down in your living room, look you in the eye, and vouch for that piece of paper.
That makes total sense.
Yeah, and the report explicitly notes that assisted selling, meaning a human being is guiding the transaction, remains absolutely critical for about 80 to 85% of this market.
So that is the true definition of the phygital model. It is physical human advisory, completely powered by digital tools.
Yes, precisely.
The human provides the local relationship, the empathy, and the trust. Meanwhile, the Turtlemint Pro app provides the instant pricing, the comparisons across those 45 insurers, and the immediate processing.
They are essentially taking the traditional, slow-moving local insurance agent and giving them a technological exoskeleton.
I love that image, an exoskeleton for insurance agents.
Yeah, they're digitizing the highly fragmented back end of the industry while fiercely protecting the human front end.
Right.
So the local agent no longer has to carry, a briefcase full of paper forms, mail them to a corporate office in Mumbai, and wait 2 weeks for an underwriter to issue a policy. The app does all of that in milliseconds while the agent drinks tea with the customer.
Okay, having 6.3 lakh partners out there selling policies and drinking teas sounds incredible from a societal impact perspective. But businesses run on revenue.
They do.
So if I'm looking at this from a purely mechanical standpoint, how does an army of independent advisors translate into actual rupees in the bank for Turtlemint? Like, volume is an amazing vanity metric, but how does the money actually flow?
Well, to understand the flow of capital, you have to look at their revenue model, which is entirely based on commission spreads.
Okay.
It's vital to break down the unit economics of a single everyday transaction to see how this immense engine actually generates cash.
Right, and the source material has a highly specific example that really crystallized this for me. Let's walk through it.
Let's do it.
Imagine you live in a B30 plus town, say a tier 3 city, and you need to buy insurance for your car. You sit down with your local Turtlemint digital partner. They open the app, punch in your vehicle details, and find a policy from HDFC eArg that costs exactly $8,000.
Right.
You hand over the $8,000. Where does that money go?
Okay, so the entire EF1000 premium goes straight to the insurer. In this case, HDFC eArg.
Straight to them.
Exactly. They are the ones actually taking on the risk of your car getting into an accident.
Yeah.
Turtlemint never holds that premium.
Got it.
However, as a fee for originating that sale and bringing them a customer, HDFC eArg pays a commission. And in the case of motor insurance, the report states this commission is typically around 28%.
So 28% of that year 1,000 premium is $2,240.
Yes.
Okay, so the insurance company hands over $2,240 of commission. Does Turtlemint take that and put it in their corporate bank account?
No, because the platform didn't make the sale, the human partner did.
Right.
The person who actually did the hard work of finding the customer, building the trust, and closing the deal needs to be compensated.
Of course.
So Turtlemint passes the vast majority of that year 240 directly to the digital partner. After that payout, Turtlemint retains roughly 3% of the total platform premium as its own net revenue.
Okay, so 3% of the original 8,000 premium comes out to just 240. Wait, hold on. Let's pause on that number. They are keeping only 240 on an E100,000 transaction.
That's the reality of the model.
That seems like a terrifyingly thin margin. I mean, how can a company survive, let alone build a multi-billion-dollar valuation on a 3% net margin?
It's tough.
Especially when they are carrying the immense costs of maintaining a state-of-the-art tech platform, running cloud servers for millions of data points, and managing an ecosystem of over 600,000 partners.
You're right. It is a razor-thin margin. If Turtlemint only sold a few thousand policies a month, the company would collapse instantly under its own weight.
Absolutely.
This is the defining characteristic of a volume-driven aggregation model. When your gross margin is effectively capped at roughly 3%, you cannot optimize for higher per-unit profit. The only lever you have to generate absolute profit is volume. Enormous, unrelenting, exponential volume.
But relying on volume introduces a crucial question,
Yeah.
Are they actually moving enough policies to make that 240 add up?
Well, the top-line growth numbers in the report are aggressive.
Right. FY24 revenue was 78.6 core. Then, in FY25, it skyrocketed to 662.7 core. And in just the first 9 months of FY26, they hit 741.1 crore, completely eclipsing the entire previous year.
Yeah, the top-line trajectory is undeniable. However, and this is the red flashing light for anyone studying the mechanics of this platform, they are currently loss-making.
Right.
As of December 2025, their EBITDA margin, which is a core measure of operational profitability, was negative 23.2%.
Negative 23%. So they are essentially losing money on every single policy they sell and trying to make it up in volume.
Yeah.
That's the oldest, most dangerous joke in business.
It is, but the data tells a slightly more complex story than that. They aren't actually losing money on the unit economics of the policy itself.
Well, they aren't.
No. That 240 they keep from the HDFC ER-GO policy adequately covers the variable cost of that specific transaction, like the server ping, the tiny incremental cost of the app functioning.
Okay, so where's the money going then?
Where they are bleeding money is on the fixed costs of running the entire corporate machine. It's the salaries of the hundreds of tech engineers building the AI, the huge marketing campaigns to recruit partners, the compliance teams. But this is exactly where the concept of operating leverage becomes the lifeline of the business.
Okay, let's really dig into operating leverage because I think it's one of those terms that gets thrown around in reports but rarely explained well. How does it save a company with a negative 23% margin?
Think of building a business like laying down a set of train tracks across a continent.
Okay.
Laying the first mile of steel is agonizingly expensive. You have to buy the land, blast through mountains, and hire thousands of workers. That is your fixed cost.
Right.
If you only send one train down that track, you have lost a fortune. But once the track connects two cities, sending the second train, the 10th train, and the 10,000th train costs almost nothing compared to the initial build. The track is already there.
I see. So the tech platform is the train track.
Exactly. The cost of their core engineering team and their software infrastructure stays roughly the same, whether they sell one policy or a million policies.
That makes sense.
And the report proves this out. In FY23, those fixed expenses consumed about 45% of Turtlemint's total revenue. The tracks were incredibly heavy, but as the volume of policies exploded, those fixed costs didn't grow at the same rate.
Right.
By FY26, those fixed costs had shrunk to just 22 to 23% of revenue.
So the absolute cost of the engineers didn't necessarily drop, but because they are processing so many millions of policies, that 3% trickle of 240 is starting to form a river that will eventually flood over the fixed costs?
Precisely. The fixed cost ratio halving over a few years is the ultimate proof of operating leverage. If they keep pushing the volume higher, they will eventually cross the threshold into profitability.
Got it.
And there is one more critical element to this survival math, something that makes insurance structurally superior to selling, say, a physical product.
Which is? Oh, right. Because car insurance or health insurance isn't a one-and-done purchase like buying a television.
Yeah.
You are legally or practically required to buy it every single year.
Exactly. The report highlights that renewals currently provide 60 to 70% of Turtlemint's recurring revenue.
Wow, that much.
Yes. And this completely alters the unit economics.
Yeah.
When a digital partner sits down with that same customer in year 2 to renew the HDFC ER-GO policy, the customer acquisition cost for Turtlemint is effectively zero.
Oh, because the trust has already been established by the human agent.
Exactly. The KYC documents and vehicle details are already securely stored in the app. The partner essentially just has to click a renewal button.
That is huge.
It is. That 60 to 70% recurring revenue stream is what creates long-term durability and drastically accelerates that operating leverage.
But if you are relying on an unending torrent of volume just to break even, and you need an ocean of customers to make a 240 margin work, you have to look at the size of the playing field. Which brings us to the macro picture. The India opportunity, the total addressable market, and the structural tailwinds pushing this entire industry forward.
Absolutely. Because if you are forced to play a low-margin, hyper-volume game, India is arguably the greatest board to play on in the history of modern economics.
Yeah.
The foundational premise of the report is stark.
Yeah.
India currently has one of the absolute lowest insurance penetration rates globally.
The projections in the source material are staggering. They estimate the total addressable market, the TAM, will reach between $150 and $180 billion by 2030.
Yeah.
And translating that into Indian terms, we are looking at 12 to 15 trillion rupees in annual premium potential. Trillion with a T.
And, analysts don't just pull a 15 trillion rupee number out of thin air.
How did they get there?
They calculate this TAM by projecting the necessary premiums of life insurance, which is historically a huge cultural driver, health insurance, and non-life products like motor, crop, and property insurance across all Indian households and emerging enterprises.
Oh.
Then, they adjust that number for the current coverage gap. And this is the vital statistic. Currently, 65 to 70% of this calculated market remains completely unserved.
Unserved. Just
Yep.
sitting there.
Exactly.
Picture yourself living in a bustling, semi-urban town, maybe 200 miles outside of Mumbai. For generations, your safety net was your extended family.
Right.
If you got sick, the family pooled money. If your shop flooded, the community helped you rebuild. But now you are realizing that informal safety net isn't enough anymore. Healthcare costs are rising. The vehicles you own are more expensive.
It's changing fast.
So imagine an entire nation of over 1 billion people slowly and simultaneously waking up to the need to formalize their risk. It's not just a standard business opportunity where a company is trying to steal a few points of market share from a rival.
No, not at all.
It's a fundamental generational shift in how an entire society manages vulnerability.
And we must recognize that this shift isn't happening purely organically either. There are immense structural and regulatory forces actively engineering it.
Like what?
First and foremost is the mandate from IRDAI, the Insurance Regulatory and Development Authority of India. They have explicitly set a vision called Insurance for All by 2047.
2047, which marks exactly 100 years of Indian independence. So the government is actively, intentionally pushing the population into formal risk management.
Yes, they are driving regulatory changes to mandate certain coverages. And crucially, they recognize that assisted selling, the human agents on the ground, are the primary enablers to actually hit this goal.
The regulator knows you can't reach 100% coverage purely through digital ads and websites.
Exactly. Furthermore, the demographic data is the ultimate tailwind. India has a median age of just 28.
28.
Yeah.
That means you have hundreds of millions of people who are just now aging into their peak financial responsibilities. They're getting their first formal jobs, buying their first two-wheelers, purchasing their first cars, getting married, having children, maybe buying their first homes.
Right.
And every single one of those major life events is a direct trigger for an insurance product.
And alongside that immense youth demographic is the tidal wave of urbanization. It's projected to hit 50% by 2040.
Wow.
When families migrate from informal agrarian structures into formalized urban or semi-urban environments, their exposure to distinct financial risks multiplies.
How so?
Well, you are no longer living on ancestral land. You are renting or paying a mortgage. You are commuting on busy highways. This transition inherently boosts the necessity for formal insurance.
That makes sense.
Additionally, we are seeing the rapid formalization of the informal sector. Millions of small and micro enterprises are entering the digital tax net via GST, and suddenly they're realizing they need enterprise insurance to protect their newly formalized assets.
And that adds to the TAM.
Oh, significantly.
Wow.
The report notes this enterprise shift adds another $10 to $15 billion to the TAM.
That makes perfect sense, but I want to challenge a potential contradiction here.
Okay, let's hear it.
Earlier, we established that Turtlemint is focusing heavily on the B30+ markets, the Tier 2, Tier 3, and rural towns outside the top 30 megacities. But if the whole country is urbanizing and moving to the cities, aren't they building their fortress in the wrong territory?
It's a critical point to clarify, and it's where the geographical density data becomes the key to their entire strategy. The report points out that Turtlemint currently covers 19,171 PIN codes across the country.
Which sounds like an enormous spread.
It does, right, but you have to contextualize it.
Mm.
There are over 750,000 villages in India.
Oh, wow.
Yeah.
So even with 6.3 lakh agents covering 19,000 PIN codes, they're literally just scratching the surface of the geography.
Exactly. The open market, that 65 to 70% of the TAM that is entirely unserved and ripe for acquisition, is vastly concentrated in these semi-urban and rural areas.
Right.
The top 30 metros are what we call a red ocean. They are hyper-competitive, heavily saturated with digital-savvy consumers, and dominated by direct-to-consumer models and legacy banks.
Okay, so the cities are already fought over.
Exactly. The B30 plus market is the ultimate blue ocean. It's precisely where Turtlemint's strategy is aimed, because that is where the trust deficit is highest, the digital literacy is still developing, and therefore where their human-led, tech-enabled network provides the maximum value.
Okay, so the logic holds up. The pie is unimaginably vast, a 15 trillion rupee pie waiting to be baked.
Yes.
But here's the fundamental rule of capitalism. If the opportunity is that obvious and the pie is that large, everyone is going to try to take a slice.
Of course.
Competitors are bound to flood in. Traditional legacy banks, heavily funded rival fintech startups, international conglomerates. How on earth does a company surviving on a 3% margin protect its territory?
Well, in strategic analysis, we look for a moat, a structural competitive advantage that protects your castle from attackers.
Right.
And the report identifies three very specific deep moats that Turtlemint has dug around its business model. The first is network density.
We touched on the 6.32 lakh advisors earlier, but the sheer static number isn't the moat, right? It's the momentum. The report highlights a 33.5% compound annual growth rate, or CAGR, in their partner network over the last 5 years.
That level of sustained, high-velocity growth is exceptionally difficult to replicate. I mean, a new competitor cannot simply arrive in India with $100 million of venture capital and instantly buy 6 lakh trusted local relationships.
No, you can't buy that overnight.
Building a network of that scale requires years of grinding it out on the ground, conducting training seminars in community halls, navigating local certifications, and building word-of-mouth trust in thousands of isolated small towns.
It's hand-to-hand combat, basically.
Yes. And the sheer overwhelming volume of partners allows Turtlemint to penetrate new PIN codes faster than any rival attempting to build a network from scratch.
Right, a competitor could hire developers to copy the exact look and feel of the Turtlemint app in a few months, but they cannot code trust.
Perfectly said.
So, moat number 2 is the technology advantage. The report specifically calls it an AI-powered, mobile-first infrastructure tailored for B30 plus locations. Let's break that down, because AI-powered is a buzzword that gets thrown into every pitch deck these days. What does it actually mean here?
In this context, it is a survival mechanism. It's not just about having a pretty interface. The technology has to be ruthlessly optimized for the environment.
Meaning what?
It has to work seamlessly on lower-end smartphones that might have limited processing power. It has to function perfectly on spotty 3G or intermittent 4G connections in rural areas.
Ah, right. It has to actually work in the field.
Exactly. And the AI comes into play by helping the local advisor instantly, quote, dynamic prices, match the specific risk profile of the customer to the right product, and process claims without ever needing to call a physical back office in Mumbai.
Wow.
The tech radically boosts the advisor's productivity, which is essential because, remember, they are operating on that thin 3% margin. They need the advisor to sell multiple policies an hour, not one policy a day.
And then there's the third moat, which might be the deepest. The ecosystem. This refers to the fact that Turtlemint has successfully integrated partnerships with 45 different insurance companies onto a single platform.
Yes, and the ecosystem moat is fundamentally about comprehensive choice and objective advisory. Think about the traditional model.
Okay.
If an agent is a captive agent, meaning they only represent one single company, say they only sell policies for LIC or only for HDFC, they are forced to push that specific product, even if it's objectively not the best fit or the best price for the customer.
Right, their hands are tied.
But a Turtlemint digital partner is armed with the inventory of 45 different corporate brands.
It's the difference between walking into a single brand boutique versus a vast, well-stocked supermarket.
Exactly.
If you are a skeptical customer in a Tier 3 town and an agent comes to your house with just one brand of policy, you are going to feel like you're being sold to. You might suspect they're just trying to hit a corporate quota.
Human nature.
But if the agent opens an app and says, look, here are the real-time prices and benefits from 45 different companies, let's look at the data together and find the absolute cheapest and best coverage for your specific family. That agent transcends being a salesperson. They become a trusted, objective consultant.
Exactly. And for a competitor to replicate that supermarket, they face a colossal barrier to entry. They don't just need the app. They have to undergo the grueling, bureaucratic nightmare of passing compliance audits, building custom API integrations for archaic legacy mainframes, and negotiating complex legal contracts with 45 separate, highly conservative insurance corporations.
Yeah.
It takes years to build that trust with the institutions.
Okay, I hear the argument for the moats. The scale of the network is incredible, the specialized tech works in tough environments, and the 45 insurer choice makes the agent highly effective.
Yeah.
But I'm going to push back aggressively here based on the financial realities laid out in the report.
Good for it.
The source material notes that while the unit cost of digital POSPs, these local partners, is 30 to 40% cheaper than maintaining traditional corporate employees, Turtlemint is still spending a staggering 70 to 77% of its total operational expenses just recruiting, managing, and paying out these digital partners.
That is an immense concentration of expense. There's no denying that.
So my challenge is this. Are they actually building a defensible technological moat? Or are they just renting a very expensive, highly mercenary crowd?
That's the million-dollar question.
Because if 3/4 of your money goes to keeping freelance agents happy, the moment a heavily funded competitor arrives and offers those same agents a 29% commission instead of a 28% commission, won't that entire moat just evaporate and walk across the street?
It's a huge risk.
What stops an agent from having 3 different apps on their phone and just using whichever one pays 100 rupees more that day?
It is a highly valid challenge, and it cuts to the absolute core of their risk profile. The primary defense against that mercenary behavior is the stickiness of the platform's workflow.
Stickiness.
Yeah. If the Turtlemint Pro app has a superior UI, if it processes the KYC documents flawlessly, if it issues the policy in 2 minutes instead of 20, and crucially, if it guarantees the commission payout hits the agent's bank account instantly without administrative hassle, then what? Then an agent might happily accept a slightly lower commission. Why? Because the superior tech allows them to sell double the volume in the same amount of time, meaning their overall take-home pay is higher.
Ah, I see.
But your fundamental point stands. The sheer cost of maintaining this human network is exactly what is driving that negative 23.2% EBITDA.
Which means they are burning cash, and they need fresh capital to keep the engine running until the operating leverage fully kicks in.
Yes.
To eventually turn this expensive, sprawling human network into a highly profitable, self-sustaining machine, Turtlemint has laid out a very specific roadmap for growth and capital expenditure.
They have.
They are preparing for an IPO, a public offering, to raise capital from the markets. Where exactly is the money going?
Well, the report details a fresh IPO raise of 660.72 crore. And as the old business adage goes, how a company allocates its fresh capital tells you exactly what they believe their core business actually is.
Show me your budget, and I'll tell you your strategy.
Exactly.
Now, as a quick note for clarity, we are focusing purely on the fresh capital being raised to fund the company's future operations. We want to know how the company is deploying its actual war chest.
The breakdown of that 660.72 crore is incredibly revealing. The largest single chunk, 322 crore, is strictly earmarked for working capital.
Working capital. In practical terms, that means the money required to keep the lights on and the massive engine running day to day.
Yes, it is the fuel required to sustain the relentless pace of partner acquisition. When you have 6.3 lakh partners and you are determined to grow that base at over 30% a year, you have to fund the continuous onboarding process. The local training seminars, the certification programs required by the regulator, and the hyper-local marketing required to bring new agents into the ecosystem. They're spending 322 crore to relentlessly feed the volume machine.
It's the cost of maintaining the phygital frontline. But the second chunk of capital allocation is what I find really fascinating because it points to the future.
Yeah.
218 crore is dedicated to technology and cloud infrastructure, and the report breaks that down even further. 193 crore specifically for tech and product teams, and 25.64 crore for cloud infrastructure.
And that specific allocation proves that internally, Turtlemint views itself fundamentally as a deep technology company, not merely a vast distribution agency.
Interesting distinction.
You do not spend almost 200 crore rupees on engineering talent unless you're building highly complex proprietary systems that competitors cannot easily copy.
But let's be practical. What does 193 crore rupee tech team actually do all day for an insurance distributor? Are they just tweaking the app to make it load half a second faster or changing the color of the buttons?
Far from it. That immense investment is a structural enabler designed to fundamentally alter their unit economics. Remember those 45 legacy insurance companies?
Yeah.
Integrating with them is a nightmare. The tech team is building sophisticated middleware to communicate with 45 different archaic mainframes simultaneously.
Oh, wow.
More importantly, they are building out AI dynamic pricing models. They are creating automated underwriting systems.
To do what exactly?
The goal is to allow an agent sitting in a remote village in Bihar to input a customer's health data and get instant algorithmic approval on a health policy without waiting 3 days for a human underwriter in a corporate tower to review a physical paper file.
That's a game changer.
It is. The entire goal of that 193 crore tech spend is to dramatically drive down the customer acquisition and processing cost over time. If the software does the heavy analytical lifting, the human agent becomes a pure relationship manager, they work faster, and the fixed cost per policy plummets.
Okay, so the strategy is clear. They are feeding the human network with the working capital and upgrading the software brain with the tech capital.
Yes.
Once this upgraded, well-funded machine is running at full speed, what are the actual future growth vectors? How do they get bigger and more profitable besides just finding more agents to push more basic policies?
The report outlines 3 primary, highly strategic growth levers. The first is deeper penetration.
Okay.
This isn't just about getting more partners. It's about converting more of the existing 6.3 lakh partners into highly active, high-volume sellers.
Because right now, some of them are barely selling anything.
Exactly. Currently, as with most huge networks, there is a core group driving the vast majority of the volume, while many agents might only sell a few policies a year to their immediate family.
Right.
If Turtlemint can use their improved tech and targeted incentives to activate those dormant partners, revenue scales exponentially without adding any new expensive onboarding costs.
That makes total sense. Maximize the utilization of the asset you already built. What's the second lever?
Ecosystem expansion and new products. Right now, they are intensely focused on insurance. But think about the position of power they hold.
Okay.
They have a trusted local agent sitting in a customer's living room having an intimate conversation about their family's financial security. Once the customer trusts that agent enough to buy a car insurance policy, the relationship is established.
Oh, I see where this is going.
Yeah, the platform is architected to eventually move beyond just insurance, allowing that same agent to distribute microloans, wealth management products, and mutual funds.
Oh, that is a vast pivot. If I've already done the incredibly hard work of verifying a rural customer's identity, collecting their KYC documents, getting their bank details, and proving that the digital transaction works by selling them an $8,000 car policy,
Yes.
offering them a small business loan or a micro investment product next year is a completely natural next step. The infrastructure, both digital and emotional, is already fully in place.
Precisely. It transitions the individual from being just an insurance agent to being a comprehensive local financial advisor for the B30 plus market. And that ties directly into the third growth lever, premiumization.
Premiumization. Moving up the value chain to richer products.
Yes. Currently, a vast amount of their volume is driven by relatively low-value, highly standardized products like basic motor insurance.
Right.
But as the partners gain experience and confidence, and as the B30 plus customers gain wealth and trust in the system, Turtlemint's strategy is to shift the mix toward much higher margin complex offerings.
Like what?
We're talking about comprehensive term life insurance or specialized high coverage critical illness policies. These products carry significantly higher absolute premiums.
Ah.
So if an agent sells a life policy with a $50,000 premium, that 3% cut that Turtlemint retains results in a vastly larger absolute rupee amount per transaction, drastically accelerating their path to profitability.
So if we step back and look at the blueprint, if they activate their dormant agents, if they successfully expand into distributing loans, and if they train the network to sell high-margin life insurance, it sounds like an unstoppable tech-enabled march toward market domination.
It does sound that way.
The heavy fixed costs of the train tracks will shrink in the rearview mirror. That 3% margin will turn into a raging river of cash flow, and they will effectively own an enormous slice of a 15 trillion rupee market.
It is a beautiful, theoretically flawless model when you map it out on a spreadsheet in a boardroom.
Ah, but as we know, reality rarely obeys the spreadsheet.
No, it doesn't.
Because as we read deeper into the source materials, the analysts highlight some severe underlying structural vulnerabilities. If the wrong variables shift, this whole carefully constructed phygital empire could come crashing down.
It's very true.
Let's dig into the Achilles heel of Turtlemint. Let's talk about the existential risks.
Okay, so the report categorizes these vulnerabilities into 3 core existential threats. The first, and arguably the most immediate and terrifying, is regulatory risk. We established earlier that nearly 99% of Turtlemint's revenue comes directly from insurer commissions.
Right, the 3,240 payout on the 8,000 policy.
Exactly. But we have to ask, who actually decides that the commission should be 28%?
Well, who does?
Currently, it's essentially a market rate negotiated between the parties, but it exists entirely under the strict umbrella of IRDAI regulations.
We're regulator.
Yes. If the regulator wakes up tomorrow and decides that insurance is simply too expensive for the common citizen and mandates that all distributor commissions are legally capped at, say, 10%, the entire Turtlemint financial model breaks in an instant.
Let's run that math. If commissions are capped at 10%, the payout from HDFC eArgo drops from 2,240 to just 800. Turtlemint still has to pay the agent to keep them from quitting. So instead of keeping 340 for themselves, they might only keep 50, but their cloud servers, their 193 crore tech team, and their marketing budgets all cost exactly the same. They would instantly hemorrhage cash.
Exactly. And this isn't just a theoretical doomsday scenario drafted by a paranoid analyst. The report explicitly documents that in FY24, Turtlemint experienced a brutal 81% year-over-year revenue drop tied specifically to business and regulatory shifts.
81%.
Yeah. An 81% drop in revenue is a near-death experience for any high-growth tech company.
So what does this actually mean for their long-term viability? It means Turtlemint possesses absolutely no pricing power.
None.
Think about a traditional dominant company like Apple or Tesla. If the cost of lithium or microchips goes up, they just raise the price of the iPhone or the car to protect their margins. The consumer absorbs the shock. Turtlemint cannot do that.
They really can't.
They cannot dictate the price of the policy to the consumer, and they cannot dictate the commission payout to the enormous insurance corporations. They're entirely at the mercy of the insurers who write the checks and the regulators who write the rules of the game. They are essentially passengers in a regulatory vehicle they do not steer.
That is an incredibly apt way to frame it. They are entirely dependent on the ecosystem remaining favorable. And that extreme dependency leads directly to the second existential threat.
Concentration risk.
Concentration risk.
When you look at the breakdown of their revenue mix, an overwhelming 94% of it comes from general insurance, and specifically motor insurance.
94%. So if you somehow magically stripped away car and two-wheeler insurance from the Indian market, this multi-billion-dollar company would barely even exist.
It would vanish. Furthermore, the concentration isn't just in the product type, it's in the partners. The top 10 insurer partners on their platform contribute 72.47% of all their revenue.
Wow.
So they are highly dependent on essentially one product category and a small handful of corporate partners. Okay, let's game this out, because heavy reliance on motor insurance in the 2020s feels like a vast blind spot. What happens to this revenue engine if electric vehicle adoption suddenly surges across the B30 plus markets over the next 5 years?
It's a huge question.
EVs have a fraction of the moving parts of a combustion engine. They require significantly less routine maintenance, and their accident and repair risk profiles are entirely different. What if the overall actuarial risk drops, meaning the premiums drop?
Yeah.
If the premium drops from 8,000 to 4,000, that 28% commission gets cut in half, meaning Turtlemint's 3% net revenue gets cut in half?
Exactly.
Or worse, what if a company like Ola Electric or Tata Motors decides to just embed the insurance natively into the digital purchase of the car, completely bypassing the local Turtlemint agent?
That is exactly the kind of macroeconomic shift that keeps their executives awake at night. The model relies on the status quo of how vehicles are bought and insured.
Right.
Or let's look at another shift.
Yeah.
What if direct-to-consumer digital adoption suddenly spikes in those B30 plus markets?
Yeah.
What if the next generation of 18-year-olds in rural India who have grown up entirely on smartphones feels perfectly comfortable buying their first two-wheeler insurance via an automated WhatsApp bot?
Without the agent.
Exactly. If they no longer feel the psychological need for a human agent to sit in their living room and vouch for the policy, the entire premise of the phygital model collapses. The heavy reliance on one specific product, motor insurance, and one highly specific delivery method, human advisory, could become a severe liability if consumer behavior shifts more rapidly than anticipated.
And if that behavior shifts, or if the market gets flooded with aggressive, well-funded competitors, we slam right into the third risk. Key person or key cost risk.
Yes.
We debated this during the moat discussion, but it's worth revisiting as an existential threat. 70 to 77% of their total expenses go entirely to compensating the digital partners.
The structural vulnerability here is brand loyalty. The Turtlemint platform itself has virtually no direct consumer brand recognition. No. If I buy a policy through a local digital partner, my trust is vested entirely in that partner, not in the corporate entity called Turtlemint.
Right.
If a rival, heavily funded insurtech startup enters the market and says to that local partner, hey, bring your entire book of business to our new app and we'll give you a higher cut of the commission and better bonuses, the network could vanish overnight.
Oof. Gone.
The loyalty of the 6.3 lakh army is fragile because it is built almost purely on immediate economic incentives.
This entire deep dive is such a stark reminder of how complex modern tech ecosystems actually are.
It really is.
You look at a company like Turtlemint from the outside, and you see 6.3 lakh agents, 741 crore in rapidly growing revenue, cutting-edge AI integrations, and a multi-trillion rupee total addressable market. It looks utterly invincible.
On paper, yeah.
But you peel back just one layer of the onion, and you see the terrifying regulatory exposure, the overwhelming product concentration in motor insurance, and the extreme cost of keeping a mercenary freelance army loyal.
It's precarious.
It perfectly encapsulates the reality of analyzing hypergrowth tech platforms. The line between being hailed as a visionary market leader and collapsing like a highly vulnerable house of cards is razor thin.
It requires utterly flawless execution from the management team and, frankly, a bit of luck regarding the macroeconomic and regulatory environment.
Yeah.
They have to grow their volume fast enough to fully achieve that operating leverage, and they have to diversify their product mix into life and health insurance rapidly before a regulatory cap or a technological shift strikes their core motor business. It is a relentless race against time.
Well, we have covered an immense amount of ground today, dissecting an incredibly complex machine. Let's do a quick recap of the journey we just took through the source material.
Good idea.
We started by exploring this incredible phygital engine, an army of 6.3 lakh digital partners utilizing the Turtlemint Pro app to bridge the vast trust deficit and bring complex financial products into India's underserved B30+ markets. We broke down the unit economics of the money machine, realizing that survival relies on taking a tiny 3% net margin and pumping an astronomical volume of policies through the system to eventually overcome the heavy fixed costs of their tech infrastructure.
Then we examined the sheer staggering scale of the opportunity. A 15 trillion rupee total addressable market driven by a young demographic, rapid urbanization, and government mandates for universal financial inclusion.
Yeah.
We evaluated the competitive moats, the sheer density of their network, a mobile-first tech infrastructure, and the incredibly difficult-to-replicate 45 insurer ecosystem.
We tracked their capital allocation, noting that the bulk of their IPO funds are fueling the working capital required to feed the human network, alongside a highly strategic 218 crore rupee bet on tech and cloud infrastructure to lower future processing costs and deploy AI.
And finally, we stared into the abyss of their existential risks. The chilling reality of complete regulatory dependence, a dangerous over-reliance on motor insurance, and the costly necessity of keeping their freelance army from jumping ship. It is a remarkable, highly optimized business model built to solve a very specific friction point in a very specific time and place in India's economic evolution.
As we wrap up this analysis, there is one final provocative thought I want to leave you with, something we haven't explicitly discussed yet, but that hovered like a ghost over everything we analyzed today.
It's the ultimate AI question.
Yes.
We talked extensively about Turtlemint using AI as a tool to help the human agents work faster. But let's look 10 or 15 years down the road.
Okay.
As artificial intelligence becomes hyper-personalized, as algorithms become capable of perfectly pricing risk on an individual basis, and crucially, as AI avatars or conversational voice bots become capable of explaining that complex risk directly to rural consumers in their local dialects with perfect empathy and infinite patience.
Yeah.
What happens to the human being in the living room?
It is the ultimate question for this entire business model. Will the phygital model, relying on a human advisor to bridge the trust gap, be seen historically as a permanent, brilliant solution to distribution? Or is it just a temporary 10-year stepping stone? Are these 6.3 lakh agents essentially acting as a bridge to get a historically low-trust society comfortable with digital finance, only to eventually, inadvertently, train the very AI systems that will replace them?
It's the defining tension of the digital age. Who ultimately owns the consumer's trust when the technology becomes entirely indistinguishable from the human touch?
It brings us right back to that invisible architect metaphor we started with at the beginning of the show. The architect builds the digital toll booth, but eventually they might just figure out how to completely automate the coal collector, too.
That's a profound shift.
It is, and it will be fascinating to watch it unfold across the Indian landscape. Thank you for joining us on this deep dive. Keep questioning the systems, keep looking under the hood of the businesses you interact with, and keep exploring the architecture of the world around you. We'll catch you on the next one.